Big picture earnings analysis is on. Today, we're looking at Ferguson's Q1 2026 results.
Right.
It was, a financially mixed quarter, but the company offered a surprisingly optimistic outlook.
It's a perfect snapshot of the economy right now, isn't it? You've got a company executing just flawlessly on everything they can control, but they're still navigating some brutal cyclical headwinds, especially in housing.
Yeah, that's what we need to get into, why solid year-over-year performance still managed to, disappoint part of the market.
Yeah.
Okay, so let's just unpack this Q1 scorecard. This is for the quarter ending October 31st, 2025.
Yep.
Top line, the news was, well, unambiguously good. Ferguson reported $8.2 billion in revenue.
Which is a very healthy 5.1% increase over last year.
Exactly. And that easily topped the forecast of around $8.09 billion.
Yeah.
So a clear revenue beat.
Right, and that revenue strength, it wasn't just volume. You had organic growth at about 4.2%, and then another 1% came from their strategic acquisitions. But here's where the story sort of fractured.
Profitability.
All eyes went there immediately. Their adjusted earnings per share, or EPS, landed at $2.84.
But hold on a second. $2.84? That's up nearly 16% year over year? I mean, that's fantastic growth.
It is.
And it actually beat one consensus estimate, so why the negative reaction from the market?
Well, this is a perfect lesson in investor psychology, right? That 284 number historically is great. It shows strong execution.
Sure.
But some analysts had set a much, much higher bar, specifically around $2.97.
Ah.
And missing that highest target by less than 5%, I should add, was enough to trigger a really disproportionate reaction.
It really was. Despite the revenue beat and that robust profit growth, the stock dropped over 3% in pre-market trading. It just feels like a very harsh judgment.
It tells you that in this kind of slowing, cyclical environment, investors are pricing for perfection. They're not looking at the 16% growth that happened.
They're looking forward.
They're focused on forward guidance and margin momentum. And when a high expectation is missed, it just implies pressure on the future, even if the underlying performance is, frankly, superb.
So let's get into that operational performance, because the numbers here are genuinely compelling. They hit $808 million in adjusted operating profit.
Up 14.4%.
So how did they manage that when their core residential market is struggling so much?
It all comes down to disciplined operational leverage. They expanded their gross margin to 30.7%.
Okay, and that was up 60 basis points over the prior year.
Right. And for anyone not, living and breathing finance, what does 60 basis points really mean for a company this size?
Good question.
It just means they're selling better or managing their supply chain and pricing better. A basis point is 1/100th of a percent.
So it's tiny, but it adds up.
It adds up massively. Raising the margin by 60 basis points means for every $100 in sales, they pocket an extra 60 cents in gross profit. And when you're talking about $8.2 billion in sales,
that's a huge improvement.
It's an immense improvement in efficiency. And that allowed them to expand their operating margin by an even more impressive 80 basis points to 9.9%.
And that's the key.
That is the key. That expansion is a clear sign that management is squeezing profit out of every dollar, which is why the underlying strength of this report is so important.
That focus on operational control clearly paid off. So now we know how they made the money. Let's look at where it came from.
Right.
U.S. net sales grew 5.3%, but their business is basically split 50-50.
Yeah.
You've got residential and you've got non-residential.
And the results paint a very, very sharp contrast between those two worlds.
I'll say.
The non-residential market was the powerhouse this quarter. That segment saw revenue growth surge by a really robust 12%. And there's one phrase that defined that success: large capital projects.
LCPs. Remember management highlighting that term. These aren't just, small commercial jobs, are they?
No, not at all. These are massive projects. When Ferguson talks about LCPs, they're talking construction values north of $400 million.
Okay, so huge undertakings.
Huge. We're talking complex, long gestation endeavors. And these LCPs, they're estimated to be, $1 mid to high single-digit percentage of the whole company's revenue right now.
And that share is growing.
And it's growing.
So what specific kind of LCP is driving that massive 12% growth? Is it reshoring manufacturing or is it something else?
The story is, overwhelmingly driven by data centers.
Data center.
They reported that data centers alone are over 50% of their entire LCP revenue stream right now. It's a structural, multi-year tailwind for plumbing, HVAC, fire suppression, all of it.
Especially waterworks, I imagine.
Oh, absolutely. The need for constant cooling and utility hookups in these massive server farms is just enormous.
And we see that success reflected in their customer groups. For example, the Waterworks division, which handles municipal stuff, grew 14%.
Exactly. Waterworks growth was fueled by those LCPs, public works, general municipal upgrades, and even more striking, their commercial mechanical customer group grew 21%.
And they specifically cited data centers.
They did. Management pointed to their internal One Ferguson strategy as key to winning this business.
The One Ferguson strategy. Is
Yeah.
that like their internal coordination system?
Precisely. It's their way of leveraging their scale. Instead of having separate teams bid on plumbing and fire suppression for the same project, they bring multiple specialized groups in early.
So industrial, waterworks, commercial, mechanical, all working together.
All working together from the design phase. They deliver a single, comprehensive solution. And that coordination makes them indispensable for these high-value projects. It's how they're capturing market share.
Which is so essential because the other half of their business, the residential side, is, it's stuck in the mud.
It is.
Residential revenue is down 1% overall.
The challenges there are entirely cyclical and macro-driven. You're seeing continued softness in new housing starts, weak permit activity, and crucially, a really sluggish repair, maintenance, and improvement segment, RMI.
And RMI is the work that usually keeps contractors busy, even when new builds stop.
Correct. It's the bread and butter work. Fixing pipes, replacing a water heater. Historically, it's their highest margin, most recession-resistant segment.
And its softness shows the consumer is really feeling the pressure.
Genuinely feeling the pressure.
The major point they called out was HVAC, which declined 6%. And they cited two specific factors for that.
Yeah, the first one is technical. It's this industry-wide transition to new A2L efficiency standards.
New federal regulations.
Right. And anticipating these new rules caused a huge pull forward of sales last year. Everyone rushed to buy the old, cheaper units. Now they're paying the price with a cyclical dip.
And the second factor speaks directly to that pressured consumer you just mentioned.
Exactly. Management noted that consumers are shifting from full replacement of an HVAC unit to just repairing it. It makes sense. Of course. You'd rather pay a few $100s to patch it up than take out a $10,000 loan for a new unit in this rate environment. So even though they're outperforming the market, those are some powerful forces they just can't escape.
It sounds like Ferguson has this successful dual strategy then. Maximize the tailwinds, manage the drag.
It's a good way to put it.
And what stands out, beyond the end markets, is their financial discipline. That gives them the flexibility to invest right through this downturn.
Their balance sheet is rock solid. Net debt to adjusted EBITDA is incredibly strong at 1.1 times.
Which is at the very low end of their target range.
Right. Their target is 1 to 2 times. That stability is essential. It reassures the market they can handle a long downturn in housing while still investing aggressively.
And they are definitely putting that cash to work. They declared a 7% increase to their quarterly dividend.
Raised it to 89 cents per share.
And returned a total of $372 million to shareholders through buybacks and dividends.
It's a confident capital allocation strategy. You're returning cash, but you're also maintaining an active growth focus.
Right, like their bolt-on acquisitions. They completed one key deal this quarter, More Supply Company.
Yeah, that expands their reach in the HVAC market in Chicago. And given how fragmented the distributor market is, these small targeted acquisitions are just a consistent driver for them.
While acquisitions are important, I think the investments they're making in organic growth, the internal stuff, are maybe more critical long-term.
I agree.
They highlighted continued investment in their trainee program, adding roughly 250 to 300 trainees. Why is that so critical for a distributor?
Because in distribution, knowledge is inventory. These aren't just warehouse workers. These are future sales experts, counter pros who build relationships with contractors for decades.
So it's an investment in expertise.
It is. That expertise is sticky. It locks in market share.
They're also building out their physical capabilities. Management said they completed about 650 counter conversions. What exactly is that?
It's a fascinating operational detail. It
Yeah.
means taking a location that was, say, mostly an HVAC supplier and adding a robust plumbing counter to it, or vice versa.
Ah, so they're catering to the dual trade contractor.
Exactly, the person who handles both plumbing and HVAC. By becoming a one-stop shop for these more complex jobs, they deepen that customer relationship and they increase their share of wallet.
And you combine that with their digital investments, and it all ties back to just making the contractor's job simpler. Okay, let's turn to the forward-looking statements. Ferguson is transitioning to a calendar year end, so they updated their guidance for calendar 2025.
Right.
They maintained their core growth expectation, projecting net sales growth of approximately 5%.
But, and this is important, the guidance showed increasing operational confidence. They slightly raised the low end of their adjusted operating margin guidance,
The new range is 9.4 to 9.6%.
up from 9.2 to 9.6. It's a small tweak, but that margin confidence signals that they believe the non-residential strength will continue to offset the residential drag.
They're putting money behind that confidence, too. They raised their capital expenditures forecast to about $350 million.
The top end of their previous guide.
That's a huge signal, raising CapEx when the economy is uncertain.
It is. It means they're aggressively investing in infrastructure, logistics, those counter conversions we just talked about. They are playing the long game. They're building capacity now for when the housing recovery eventually happens.
However, the immediate near-term picture, it still looks pretty constrained.
It does.
What's the view on the current quarter?
Yeah, management was very transparent here. The calendar Q4, so October through early December, is seeing a slowdown. Total growth is projected to be around 3%.
And that's directly because of residential.
Directly. Continued pressure in new residential construction and those tough deflationary dynamics in the HVAC market. They expect that 3% growth rate to carry into early 2026. So the big trends are great, but the immediate future is slower.
Let's talk about pricing and inflation. It's always so complex with them. Overall inflation was about 3% in Q1, up a bit from 2% last quarter. How does that break down?
It is a truly mixed basket, which makes pricing discipline just paramount for them.
Okay.
Finished goods pricing, so faucets, fixtures, appliances, that saw modest improvement. It's sitting at the high end of the low single-digit range.
Which is pretty healthy,
Yeah.
pretty normal.
Very normal, healthy level. But the commodity side is a challenge.
It is. The overall commodity basket is still deflationary, down in the low single digits. And here's a striking detail. PVC, their largest commodity basket by volume, is in low double-digit deflation. Wow, that's a significant headwind.
A massive headwind. They have to overcome that with volume and margin execution elsewhere.
But at the same time, other key commodities are going in the opposite direction.
Exactly. They reported mild inflation in steel and strong inflation in copper tube and fittings.
Which are critical for that data center business.
Critical. So looking ahead to calendar 2026, they expect price increases will normalize, focused mostly on that finished goods side. It suggests they're not expecting a return to that intense inflation of the last few years.
So what does this all mean for you? The primary takeaway here is that Ferguson's corporate health is just defined by duality. They are successfully leveraging these massive long-term projects like data centers and infrastructure work, and they're using aggressive strategic market share gains to offset the very real cyclical weakness in their core residential markets. Their ability to deliver expanding margins and generate strong cash flow while raising investment levels, that's what distinguishes their performance.
And that raises a really important question for you to consider as you watch the construction sector. The CFO himself noted that these large capital projects could be inherently lumpy.
Right, because they take so long to plan and ship.
Exactly. The revenue stream isn't totally predictable quarter to quarter. So given that potential bumpiness, how essential is an eventual recovery in the new residential and that high margin RMI segment for their profitability in 2026?
That's a great question.
Ferguson has used these structural tailwinds to counteract the cyclical headwinds so far, but the true magnitude of their future growth might just hinge on whether the average homeowner finally decides to replace that 20-year-old HVAC unit. Something to watch very closely.